In this week's update, inflationary pressures accelerating. More to come in the US market decline. All markets seeing large volatility, and Aussie miners a bright spot. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Let's look at the overall market perspective. At the moment, the big picture remains that what we have on our hands here is a significant multiple contraction in PE ratios and revenue to market cap ratios due to this reversal of 4 decades of interest rates falling. And we've now turned the corner and we're heading back up at some yet to be determined rate. The media at the moment, and certainly in the short term, justifiably, the market is moving according to what's happening in the Ukraine. But that is not the cause of this cyclical bear market. It is just an add-on to what was already a very significant change in financial markets. Adding fuel to the decline, of course, is the rise in oil prices. And we had West Texas Intermediate crude up at $120 during the week. And if that continued, it's going to feed into inflation and ultimately could lead to recession. And of course, that will bring some more significant stock declines with it. But that's not a given as yet. Now, the other factor that the markets are watching very closely is the potential for the 10-year, 2-year yield curve to invert. In other words, short-term interest rates to go higher than long-term interest rates. And that is generally, not always, but generally, confirmation that a recession is coming. Might not hit officially in terms of the numbers for 3 to 6 months or a bit longer, but generally it indicates that a recession is coming. And of course, markets will start to price that in before the event. And it's only 2 years ago that we had oil prices that were for a week or so were negative. You could buy oil and get paid for it, and you compare that now with $110 or $120 a barrel, and it's quite an extraordinary change. The good news is that there's plenty of Aussie mining stocks that have remained very resilient during this period and have very, very exciting outlooks for the future. So that's the good news. The potential for Fed policy error remains. I've been talking about this for a long time. It's probably the biggest single issue for markets. If the Fed, under the pressure from the public and from government, raises short-term rates too fast, then the yield curve will invert, and that's going to be a concern for markets. That's for sure. We're seeing big volatility swings at the moment. This often occurs as bear markets, cyclical bear markets, start to reach their lows or their conclusion. And we're seeing it in currencies, in bond markets. We're seeing it in commodities. We're seeing it in stocks. There's some really big daily and intraday fluctuations. And we had the incredible situation during the last week where the trading of nickel in the London Metals Exchange was actually suspended because the fluctuations in the nickel price were just far too extreme to allow to continue. So, markets certainly are moving around a great deal at the moment. Let's just look at a couple of charts. I just want to look at this 10-year. 2-year yield spread. So normally this would run somewhere between 1.5% and 2%. In other words, the longer term yields, the 10-year yields, are going to be offering a better rate of return than the 2-year yield, which is what you would normally expect. And when the yields invert, it means that short-term rates are higher than long-term rates when they go below zero, and that is generally indicative of a recession. Now, we had a little dip here in 2019, and it didn't last, and we came back out of that, and we actually climbed back to the spread being about 1.6%. But as you can see, that was in April of last year, and since then, 11 months later, we're now down to less than 0.3 is the differential. So this is plummeting quite quickly. So this is certainly a chart to watch. The VIX, always important. If we go back and look over the last 6 months, you can see we've now moved from a baseline between 15 and 20 on the VIX, and we're now in a sustained uptrend, which in itself is unusual. You know, you tend to get spikes in the VIX that last for a few days or a few weeks, and then it comes back down again. You know, and that happened in December of last year. It happened in the end of January of this year. But now we're sustaining above 30, which is rather unusual. So I wouldn't be surprised to see before this cyclical bear market completes that we see this up above 40. There's the 1 month chart, so you can see the consistent higher highs and higher lows. And if we look at it over the last 5 days, we did get a tick up on Friday night in the US with stocks pretty emphatically declining in the US. Okay, American stocks, the S&P ended up falling 2.9% for the week. And when you look at a couple of hundred individual stock charts, as I do every day, it was really, really obvious just how emphatic that decline was. You know, nearly every stock I looked at closed on or very close to its lows, and looking really quite negative. It was very, very hard to find anything that wasn't very, very negative on Friday night. So I don't believe that the cyclical bear market is done in the States yet. Inflation has now reached the highest level in 40 years. Now, over recent months, I've been talking about the fact that inflation numbers would get worse because the inflation numbers are relative to the same month in 2021. And up until about May, the inflation CPI numbers in the States were relatively modest. And so the comparisons now, as inflation spikes up, are looking pretty awful. But once we get into May, June of 2021, the inflation numbers start to kick up there. So the relative year-on-year increase is going to start to look better, unless, of course, inflation just gets completely out of control with the oil price. But putting that aside, I think we're going to start to see some moderation in the numbers and some moderation in the rhetoric around inflation. At the moment, everybody's scared of inflation, and the Fed is having to make the appropriate noises. But if inflation moderates and expectations moderate, that takes the pressure off the Fed well and truly to raise interest rates, and I think markets will certainly like that. So a lot hinges on the oil price right now, that's for sure. The other number that came out through the week was consumer sentiment in the US, and it was down quite sharply. So this is all classic cyclical bear market stuff. You know, it really is. This is playing out pretty much in a predictable fashion. I'll talk a little bit more about that later. So as far as the American market goes, I can't find anything that I want to buy. It's really a market to be avoided on the long side for now, or if you have the skill and the capability, short it or buy put options. But otherwise, very, very risky buying anything to the long side in America at the moment. Australia, different matter altogether, but I'll get to that. Now, the US dollar rose up to 99.12. The 10-year yield has now spiked back up again, back up to 2%. And the VIX remains elevated at 31. So let's look at some charts. And what I want to do is just roll through and reinforce in everyone's mind just how negative the chart patterns are across a broad section of the US market, and then compare that with stocks that you might be looking at in Australia, and I think you'll find that the trends are very, very different. So this is the NASDAQ first of all, and the two things I want you to look at. One is the moving averages. So the red line is the 200, the blue line is the 50, and the green line is the 20. Have a look at the moving averages, where they're pointed, and then where the prices are relative to those moving averages. So this is the NASDAQ. All the moving averages have rolled over or just about to, and the price is below it. So that's pretty negative. Lower highs, lower lows. So that's the overall NASDAQ. If we look at the spread between the NASDAQ and the S&P 500, a falling line means that the NASDAQ is doing worse than the S&P, and that's of course what we'd expected. And now we've now broken key support on this relative ratio, and you can see that normally in a healthy bull market, the NASDAQ is rising relative to the S&P. So we definitely have a different market character on our hands. The NASDAQ, however, is influenced by some larger stocks quite heavily. So let's remove that influence and look at an ETF. And there's numerous ones of these that you can look at. But WCLD, it's 93% information technology stocks. There are 76 stocks in there. The top 10 only make up 16.5%, and the largest holding is 1.75. And there's none of the Amazons or the Googles or the Microsofts or any of those stocks are in here. So this is a more accurate representation of the broader NASDAQ. And you can see just how sharply that is falling. Again, just observe the moving averages, the price relative to them, and you can see there's no argument about the trend. This is just another one. So this is FDN. This one does reflect larger cap tech stocks: Amazon, Google, Cisco, Facebook, Salesforce, Netflix, PayPal, and Airbnb. Again, you can see extremely negative on the larger stocks as well. Let's look at Alibaba. The reason I've put this here is there are still commentators and some fund managers out there that are making a very logical argument based solely on fundamental logic. And that's fine if you've got a 5-year time horizon and you don't care what happens in the next 6 or 12 months. But most people aren't in that category. So people are still saying, China is still an attractive place to invest. But really only if you've got a 5-year horizon and if you can completely switch off and ignore what happens between now and then. So for me, the current trend supersedes the rational case. And look at the trend. How could you possibly advise anyone to be buying stocks in China in a trend that's doing that? And yet numerous fund managers continue to make the case for China. Alibaba was trading at over $300, closed on Friday night at 86. And I don't know where the bottom is. I really don't. HYG is important. This is the junk bond high yield ETF. And you can see what happened in the COVID crash. We got down under 70, got down to 68, and it's really starting to accelerate to the downside. So that's just another sign of problems in the bond market. And if the bond market gets untidy, then that definitely flows into stocks as well. This is another one of many stocks that were beneficiaries during COVID. This is DocuSign, but I could show you 100 of these. During COVID, the price actually went up very, very significantly. Went from around 60, 70, got up to over $300. But just look at how rapidly that has come off now, because we now have a different environment, and we now have a market that is just not prepared to pay the multiples anymore for the possibility of future earnings. And what we're seeing in the latest result from this stock is the growth is just not there to justify those high multiples. Let's look at Apple. Apple's been very resilient, and you could look at that and say, well, that's a real positive, and maybe it will prove to be the case. The other way of looking at this is that Apple has not yet broken down, and is that breakdown just getting started? Because this is one of the highest quality companies in the world. It's a stock that I fully intend to buy, but not when it's poised to break down. I just don't know where the entry price might be. And if Apple breaks down, then the indices have still got more downside. And just finally, we're seeing this is GLD, which is the ETF that tracks the gold price, versus the S&P. And you can see that gold was underperforming the S&P for a long period of time. That turned around in early January, and gold has actually been doing better than the S&P since then, and quite sharply. Okay, so let's now look at the S&P index, just for the record. It's not one that I'm sort of tracking closely. I'm looking more at the internals of the market. But at the S&P level, you can see that we closed at 4,200. We've clearly now broken this 4,300 support level, and all the charts that I've just shown you point to the S&P heading down towards. I've got a nominal target down here at around 3,800. And I don't see anything that suggests that we're not going to get there. Now, there's some other spread charts that are important to look at. All right, these are the ones that I normally look at each week. This is consumer discretionary versus consumer staples. We did have a bounce back in the early part of the week, so consumer discretionary stocks getting a bit of favour from the market, but that did turn down again on Friday. But if we look at the Dow Jones small cap growth versus small cap value, we've had a little consolidation here, but it looks like it's about to drop into another new decline. So that means that money is flowing preferentially into non-growth stocks, or money's flowing out of growth stocks and it's going somewhere else. This is the large cap, or mid caps, I guess you'd call them, the Russell 1000 growth versus value. Really steep decline, not showing any signs of turning around. When we get to the bottom, you will see these charts start to turn up. Money will start flowing back into growth stocks. And that chart we looked at before. Okay, let's move on to the Australian market. The Aussie dollar is a lot stronger than you would expect, and that's because of soaring commodity prices. And I prepared these numbers prior to Friday when the US dollar ticked up, but soaring commodity prices has seen the Australian dollar actually rise 5.5% versus the US and 8.5% versus the euro. So that outperformance by the Australian dollar may actually continue the way that commodity prices are going. And it's also very abnormal in a crisis situation for that to happen. Normally the Australian dollar gets added downward pressure in a crisis. So this is something very different to normal. Our main index was down 0.7% for the week, and it's really just resources that continue to provide the relative strength. If energy and materials sectors weren't doing what they were doing, then our index would be down significantly more than it has been. So we'll take a quick look at the currencies. There's the US dollar. We're getting close towards the 100 mark. We peaked out at 103 in March of 2020, and just a little bit higher than that in December of 2016. But you can see quite a steep uptrend in the US dollar. And you would expect to see quite a steep downtrend in the Australian dollar, but just in the last few weeks since commodity prices really took off with the Ukraine situation, you can see we've been quite buoyant in our market. If we look at the ASX 200, it's not that far off all-time highs, which was 7,600, and we closed at 7,000. So we're only about 500 points, or less than 10% off the peak, which is good relative performance, but only because of commodity prices. Energy has certainly contributed significantly to that. Turning now to precious metals, gold rose by $15 to 1986, and it was a big range for the week. 5% is a big range for gold. and we'll see that in the charts in a minute. And it actually reached an all-time high, double top with the peak that we saw in 2021. Precious metal stocks, GDXJ. As I pointed out last week or the week before, there is long-term underperformance. If you look over the last decade and a half, then gold stocks have been underperforming the gold price. But short term, we might just be seeing some better signs for gold stocks. It's not definitive, but we'll see. So looking at the gold price on a daily basis, you can see some very big swings. Tuesday we were way up. Wednesday saw a huge reversal back down again, and then it just chopped around for the rest of the week. If we look at this on a weekly, you can see there's the all-time high, August of 2020. Correction, I think I said 2021, but it was certainly 2020. And we got up and we basically have formed now a big double top, but backed right off it as we saw added strength in the US dollar. But you can certainly see that there's added momentum behind gold. And silver not doing as well, surprisingly. Given that silver is an alternative to owning gold as a hedge, but it's also an industrial metal that's seeing increased demand as well. Turning to GDXJ, we're now at a key resistance level, but it is outperforming the S&P, as we can see down here. So the last week or two have been quite good for gold stocks, but really does need to break out above that level. Turning now to other commodities, copper was down quite sharply, 4.59, and nickel ended up being suspended at 17.13, I think on either Monday night or Tuesday, but it had traded at $22 intraday before the suspension. And this is all around a short squeeze that's going on because of a very large Chinese company was just in the normal part of their hedging program, has been caught out very, very substantially. And the market can be pretty brutal if it knows that someone is exposed on the wrong side. And so there was a big squeeze in nickel, and it'll be very interesting to see where nickel trades when it comes back. Crude oil got up, or WTI crude oil got up to 120, but then eased back, finished 109. Now the US has now confirmed that they're going to join the UK in ceasing imports of Russian oil. The whole oil patch is very, very geopolitical at the moment, very unpredictable. So hard to know how that one plays out. And the oil price is up 30% since the Ukraine war started. And this, of course, 30% rise in the oil price feeds into inflation very, very strongly, and ultimately, if it's sustained for long enough, into a recession. The energy market was already tight in terms of supply and demand. We've now got supply significantly reduced. OPEC will obviously step up and increase. There's reports in the media that America's talking to Venezuela about increasing supply. But look, frankly, Venezuela's got an infrastructure problem. They can't just switch on significantly higher rates of export because they just don't have the infrastructure to deliver it. So there are no easy solutions, and it's really hard to see what's going to bring that oil price down very much in the short term. These are spot copper charts, so you can see we reached $4.80 before we backed off a bit. Now this chart is only showing the nickel close. It's just being a one-year chart, it's just not reflecting what happened, but the final price before suspension was $17. So my final thoughts, where we stand at the moment, the oil price is really creating a great deal of uncertainty. Supply was already stretched. You have to say that the path of least resistance is upwards when it comes to the oil price. It's going to create significant inflation, so central banks can either let that inflation run and try and deal with it in other ways, or they've got to raise interest rates, which is going to crimp demand globally. It's one of the two. We're either going to have high inflation, or we're going to have significant demand destruction to get that oil market back into balance. And if central banks decide to go the latter by raising interest rates and crimping demand, then we could end up in a global recession, and that's the wild card at the moment. That's the uncertainty. Where you don't want to be at the moment, with all these things going on, the big picture of multiple contractions still playing out, plus the Ukraine war and all of its consequences for commodity prices, you don't want to be in cash unless it's cash that's sitting there for strategic purposes. You're going to move it back into the market at appropriate opportunities. But just to be sitting on cash long term, you're going to get eaten alive by inflation. You want to avoid being in businesses that lack pricing power, because their costs are going to be going up, and if they can't pass those on to their customers, then they're going to be in trouble. You also don't want to be in businesses that are lacking growth. You've heard me say this before, growth covers up a lot of potholes. Low growth businesses are really going to struggle with technology advancing so quickly. You want to avoid stocks that aren't part of megatrends in either commodities or technologies of varying descriptions, because they're just not going to have that guaranteed tailwind. And the one thing you want these days is to be involved in trends that are virtually guaranteed. They're going to unfold no matter what. And if stocks aren't part of that, then they're going to be much higher risk. And the other area, of course, is stocks that are on high PEs or high multiples of sales with the promise of future earnings. Now, those stocks have already been beaten up very, very severely, but they could lose half their value again without too much trouble. Now, where you want to be, commodity stocks, no question. You just got to look at 20 or 30 commodity stocks in Australia, either existing producers that are currently profitable or developers, but only developers that have got a world-class resource, because there are hundreds and hundreds of copper stocks, nickel stocks, gold stocks, lithium stocks to choose from, that the market is only going to reward a small handful, and the ones they're going to be looking at are the ones that have already proven a world-class resource. They may not be in production for 1, 2, 3, 4 years, but at least they've proven they've got a world-class resource. And so I think they're the preferential stocks to be in. Now, of course, also technology stocks that have got high future earnings visibility. The one thing the market is not tolerating at all is we don't know when we're going to make a profit. We're just targeting, it's a land grab, as Afterpay Touch did. It was a big land grab globally. Just get as big as you possibly can, as fast as you can. Just focus on sales growth. Don't worry about profitability. And the market embraced that for a number of years, but that's all changed. That period has gone away and may not come back for a considerable period of time. I'm talking years for that market sentiment to turn back again. So you want stocks that can demonstrate to the market that they're going to be making a profit next year or the year after or the year after that. So the market will want to see that earnings visibility. Now, the renewable energy sector is interesting because some of the stocks I think are going to do really well, and some are still in that category of, it's all about just growing revenue and don't worry about the profitability, and markets aren't going to treat them too well. So renewable energy, I think, offers opportunity because it's part of the mega trend, which is without question, but you've probably got to be a lot more careful in selection in that area. So for me, this is a textbook cyclical bear market, if I can put it that way. Not that, there's a standard way that it goes, but at a big picture level, this cyclical bear market is playing out very, very nicely. And if you look at cyclical bear markets within secular bull markets, then the longest one that any one of them has run since before 2000 is 3 months. Now, that doesn't guarantee that this one will only last 3 months, but that's history. They're typically short and sharp. So, hopefully it's playing out very predictably, and hopefully we don't have too much further to run, because we're 2 months in to this cyclical bear market now. And if it plays out like others of the last 2 decades, then, or even 3 decades, to be honest, then, we may not have too much longer to wait. But look, the fact that it's playing out predictably, and that's my point, is that it just provides added confidence to the process. The process that hopefully you've got a game plan around. And the process that I use is I observe many charts and indicators, and I respond to it, and that's all according to a very highly organised plan. It's not rocket science. You've just got to be organised and disciplined in how you go about things. Portfolio analyst last week, I looked at a number of Australian high conviction stocks and target prices. Also looked at just putting future earnings in perspective. That gets back to something I was talking about earlier in this video. We also covered cybersecurity stocks as well in Australia. And overall, it was a pretty productive session. That's it for this week. There's more information on the website. There's my email address. And I'll be back with you next Sunday. Cheers.